to the Rates and Lanes podcast. I'm your host, Rico Muhammad. My good friend over there, somewhere on the screen, that's Chuck Snow. Got the similar haircut as me. That other handsome fellow, that's Mr. Dean Croak from DAT. And he is going to be our esteemed special guest this evening. We appreciate it anytime we can get Dean on, even though we look like we might have caught him a little indisposed at the moment, but we'll take him nonetheless.
Yeah.
So this week in freight, we are having some. It has been interesting to say the least. Freight market is showing real improvement, but it isn't the market where every load is automatically profitable. Rates are up, capacity is tighter, and carriers will have to control deadhead and detention and operating costs to try to maintain a profit. Dean, I know you're not in front of your computers, but we got a couple of graphics, so we I guess we'll kind of just kind of see how good your memory is, and we're going to start off this week. Talking about fuel. Fuel is up again for the fourth week in a row. We're showing that the average, and these numbers come directly from Dean's market updates that he publishes every. You send those out on Saturday, right, Dean? Oh, Dean might be frozen.
He's in California, pretty warm.
He might be frozen, but anyway, we'll see if we can get him back in the mix here. So we're showing that the diesel average price of diesel fuel showing at $5.34 on average nationally. That is up by 3 cents from the previous week. Cost impact 8.5 cents per mile since July 13th. If you're averaging 6.5 miles per gallon. So recover the weekly increase through fuel surcharges and lane-specific pricing. Price deadhead before you accept the load. And I heard Dean come back in, but we don't quite have his visual yet, and I'm not sure if we even have his audio. But we'll see if we can get him back in here in the mix. But for the fourth straight week in a row, and I know it's been a little bit difficult on pricing freight on the spot market because things have kind of seemed to have tightened up a little bit. We're still coming off the seasonality of the lows of the market for the month of July. We're going into August. Some things should be starting to pick back up. We have school starting back up again. And so we're starting to see a little bit of this, a little bit of more volume coming back into the market. But it seems that a lot of shippers are also trying to protect their margins as well, and I've heard and seen some indications that they're shifting stuff over to intermodal.
Yeah, that's always
I'm not sure.
That is true, and where the transit time allows, they will use intermodal if it's better price, if they can get away with it.
Yeah, I'm waiting to see if Dean pops back in. He hadn't popped in just yet. I keep hearing it sounds like he's popping in, but it hadn't popped him in just yet. But we'll kind of keep the show rolling without him until we get him back in the mix, and we'll circle back around and see if we got some insight from him on some of these different things. So moving right along, jumping over into the dry van portion of the report. We're showing that the average rate for dry vans this week is coming in at $2.28 per mile. That is down 1.9% week over week. We are still year over year, we're still up 40.5%. And the load to truck ratios for dry vans nationally is sitting around 10.38. Top origins for dry vans is the California market. And of course, like we always kind of refer to when we are sharing these rates with you guys, that these rates are showing without fuel surcharge. So your mileage may vary. So you may be very well having a much higher rate. But the top origin for dry vans is showing that the California market is the one that is producing the most. All right, there goes Dean. There he is.
Oh, there he is. Welcome back.
We got him back. I don't know if we got his audio though.
Can't win sometimes for losing.
No, no, I'm not sure if we got his audio. Maybe he might be in a very bad area, but we'll try to see if we can. We'll try to see if he picks it, if he gets a stronger signal where he can get his audio in there.
There are some
Um,
tariffs that are coming due very like any day now. So there's been a real push, as my understanding, off the coast, and California being the biggest shipyards. So that's why a lot of intermodal has been taking place too.
and so, yeah, out of that top origin for dry vans, the California market, we're showing that they're averaging $2.61 per mile coming out of California. Then, of course, that's without the fuel surcharge included for dry vans. So, and we're gonna jump over and we'll see if we can get Dean. Dean, we still don't quite have your audio.
Okay,
We'll see if
I
we
can hear you. Okay,
There
can
we
you hear me
go.
okay?
You just
There
popped.
you go.
You just
Okay.
popped in magically.
Well, I just got to the top of Donna Pass, so I'm going to pull over. Yeah.
Okay.
Yeah, I've been out
Oh.
here in California all week. Capacity is very tight for reefer and bed. It's on the drivers here.
So tell me something I want to know. Is some of the impact on the dry van market created by what's coming in offshore?
Yeah. Just give me a second, Chuck.
No problem.
Could you repeat that, Chuck?
I just want to confirm. My understanding is that some of the activity in California is being driven by the amount of freight coming in offshore to beat some tariff dates.
Yeah. So June was the big month for imports. They were down slightly in July. So there's the peak import season has happened, which
Right.
creates a bit of an air pocket later in the year when you'd normally see peak season.
Right.
And but of course, all that freight now that's sitting in the ports, Chuck, has got to move inland.
Of course.
So that's why I think you're going to see some dry freight demand, dry van demand coming up very shortly. Produce season's starting to ease, but rates are holding, in that 20 to 25% higher year over year, even though produce volumes are down somewhere in the order of about 8 to 10% so far this
So
year. There's definitely a sense. Just listening to Rico talk about the whole market. Yeah. Go on.
So the produce is being down too. Is that because other markets are competing, your local markets throughout the United States and
it's
Canada?
just that soft. It's just softer consumer demand, Chuck. That's all it is. It's there's just we're all buying less. We're eating out less at restaurants. We're buying more frozen at so there's just less produce demand. We were out on a field on a farm harvesting lettuce and watching some of the workers work, and they were leaving maybe 15 to 20% of the lettuce. They were going over it, not cutting it, and they just plow it back into the ground because they didn't have the demand for it. Because I asked the farmer, why aren't you cutting every piece of lettuce? And he said, well, we don't need to. We're way behind on our numbers. So, so produce volumes are down, but there's, we've still got a very soft freight economy. And I think that's why everybody needs to sort of appreciate what Rico's saying with the rates. The rates are dropping. This is one of the, it's one of the steepest drop-offs in spot rates that we've seen for many years. In dry van, we've seen dry van drop 23 cents since July 4. Reefer's down 21 cents, flatbed's down 21. And if you go back and look at the same period back over a decade, which is July 4 to today, this is the sharpest decline in spot rates in that period of time since the 2022 freight recession started. So what this underpins is all of that steam that was built up in June when all the imports were peaking, that's disappeared out of the market, and spot rates are dropping and tender rejections are starting to fall. And we're heading into this period now where I think, Rico, large shippers like yours are probably going to feel a little bit better about their pricing decisions, because up until July 4, they were looking at a runaway market,
And
whereas it's just cooling now as summer demand fades.
so, Dean, I'm hearing, and I'm not sure if you have any indicators on intermodal, but I'm hearing that a lot of people are intermodal is really picking up and taking. So a lot of the stuff people are saying, where did the volume go to? A lot of the volume is kind of shifted over to intermodal.
Yep, 100%, because of the lower fuel surcharge, and they'll trade off the transit time with the capacity on the rails and 53-foot bands. So you're absolutely right. But we saw this 4 months ago. So when the war started with Iran, shippers were already looking to move to intermodal. So that's been going on for probably a solid 3 months now, that they've been switching to intermodal, and that's taken up some of our volume. That's correct. But then underlying all that, Rico, Chuck, you've got this two-tiered freight economy that's still going on. Like, demand isn't broad-based across every sector. It's fragmented. You know, it's anything to do with AI data centers that we've been talking about for years.
Right.
That's booming. Housing construction, interest rates are high. Housing starts and housing construction's down. So it's not, you know, I can't wait for broad-based demand and the whole economy to lift, but it's not. And so when you see pockets of the market down and some up, how it impacts carriers, it really depends where you run and what equipment you've got.
Yes.
Because and that's why showing on the charts you've shown the regions, that's really important, because, you know, no one's moving freight at the national 7-day average. They're moving it at the region in the southeast where Rico is, or on the west coast where the imports are coming in. That's
Right.
where the rates are really important. But we're still seeing a market that's relatively soft from a demand point of view, but not cratering. But, you know, and there are some signs that it is improving despite all of the economic and political upheaval.
Right. So I was talking a little bit before when we lost you earlier, and I brought it back up. For the 4th week in a row, diesel fuel is on the incline.
Yeah.
So that's a critical component when you're talking about diesel fuel, because you got to have diesel. That's a key component to your operation. So you got to have that to run. And if your truck is averaging 6.5 miles per gallon, that increase adds approximately 8.5 cents per mile to your operating costs.
Yeah. Well, we've had diesel's up $1.05 since the war started, so it's up about 24%. What's been providing carriers the cushion up until July 4 was the tearaway spot rates. They were providing a much needed cushion. But we're getting to a point, if rates keep dropping and diesel holds where it is, we're starting to get into that cash flow crunch territory. So we need diesel to come down quickly, because, Rico, when you look at the math, you know, $1.04 per mile, $1.04 gallon up since the war started has added somewhere in the range of about 12 to 15 cents a mile to a small carrier's operating costs in the spot market. Now, rates have gone up more than that, but, you know, depends on your fuel, like I just mentioned. So I expect, you know, rates to keep falling. They do this every year. We're coming off this big high that we had. Sugar rate before, and the market is now starting to cool. So, I mean, brake check will be capacity tighten, take time off, but then rates, then they start to pick up again. So that's sort of the state of the market. I'm not surprised the market cooled off. A lot of people were saying that the market's going to, you know, it's going to be a tearaway market. Rates are going to continue to surge, and I said no, because I didn't see the demand underpinning a tearaway market, because demand was very fragmented. I thought as soon as July 4 came around, the market would lose all of its steam and rates would cool off. And that's pretty much what they've done. But they're cooling off to a 35 to 40% higher floor than they were last year.
Right.
But
That's what I was.
high.
There is a silver lining to that great cloud.
Yeah, exactly.
And that is because of the intervention by FMCSA, correct? To clean up.
Correct. There's 6. They've got 6 major initiatives that fan out into 20 individual actions. So Delilah's Law, ELD, you know, getting rid of these shady ELD operators, English language proficiency, training school audits, non-domicile CDL. There's 6 major, and the southern border cabotage deal where they've stopped the Mexican carriers running beyond the free trade zone. They've taken away about 3,200 visas. So when you look at the 6 major initiatives that span out into 12 individual pieces of legislation across the states, it's had a massive effect on capacity, and capacity is sort of, I still see them out there as carriers will need big, but we're seeing them up.
Uh-oh. Your audio's going in and out real bad on us there, Dean.
If any of our if any of our listeners, this is a live show, so if you've got a question for Dean Croak, please send them over. We've got Dean; he is one of the foremost experts in the industry. So send them over, guys and girls.
Yeah.
All right. It looked like he popped back in. I'm just going to jump back over.
Okay.
Go ahead. Finish
I was just going to say that so Delilah's Law is waiting a House vote. That codifies English language proficiency roadside inspections, but it also means English language only at training schools. So it starts to, and that means an executive order with another administration can't take it away. Right. So that's what we're trying to do. You know, the industry is pushing hard to get a lot of this legislation in place, and it does have bipartisan support.
Right.
So that's sort of a key piece of initiative that keeps that, came in that shouldn't be here out of the market, especially the carriers that came into the industry with those sort of dodgy CDL licenses where they didn't even have any seat time in a truck.
Right. Okay. I got the flatbed numbers up for this week. Flatbed averaged $2.79 per mile on average, and once again, our source for this is from the man, our guest of the hour himself, Mr. Dean Croak. That at $2.79, that's without the fuel surcharge. That is still down 4 cents from the previous week.
Yeah.
Loads fell by 6.1%, while average trucks increased 1.7%.
Yeah.
So the load to truck ratio dropped. And I don't really know if you can really call it a drop for flatbeds. It was sitting at 40.07. It's down to 36.97, but that's still pretty dang on good.
Yeah, it's got a very strong correlation to the direction of rates. So it eases when, load post volumes are easing off. There's no question heat's gone out of the market. But
and the southeastern region led the flatbed market, averaging $3.40 per mile, and followed by the Ohio River at $3.32 per mile.
Yeah, that's
But according to Dean, the Ohio River was the strongest weekly mover, increasing by 1.2% for flatbeds.
Mm. Yep. So,
oh man,
I'm still
he dropped
here.
out right when I was trying to set him up. Let's see.
So I did some studies on this because I've been trying to figure out how well a carrier is doing compared to, prior months or prior years, right? So when you look at real margins, so what I did, I built a model and I went back and said, what were my operating costs for a dry van, reefer, and flatbed in 2018? And then I inflated it I adjusted it with inflation, my operating costs all the way. And then I overlaid spot rates, including fuel. So not all of the fuel surcharge onto that whole. And I said, how much money did I make in the last 8 months compared to the last 3.5 years? Am I out of the hole yet? Like, have I recouped all of my losses? Well,
not even close.
Well, so it's on my model. Like, so this is sort of, everyone's costs are different, but if you start off with $1.80, you end up at about 205 operating costs. But carriers went negative. They went into the hole and started to trade below break even in April 2023 and didn't get out of the hole until November last year. So they were 29 of 32 months in the red, losing money. Yeah. Now, over that period, they lost they lost about $21,500 in terms of, the bottom line. Now, in the last 8 months, they've got back 94% of that. So they're still behind about $1,200. So they're almost back to break even, Rico, like almost back to square one.
Back
So,
back to break. I was okay. That's
Yeah, but what other industry other than maybe farming do you work so hard to hopefully break even?
Yeah. Well, so that's sort of the and reefer is not dissimilar. It is has gone through a very pattern here. Reefer was. You guys can still hear me?
yes, sir. We got you.
Yeah.
We
Yeah.
lost
So
we lost your visual, but we still got you.
yeah. Oh, I'll just go back. So reefer was in the red for 18 of 22 months. 80. They were in the hole for 18 of 22 months, using the same logic. Operating costs, rates minus operating costs. But reefers had such a good run in the last 8 months. They're well ahead. They're like 20 grand ahead. And I said, but in flatbed, guys, flatbed never went negative. So for 14 of the 20 odd months, Drivan was in the hole. Sorry, flatbed never went negative. Now remember, my operating costs include a 60 grand wage, 10 grand for insurance, so it's pretty middle of the road operating costs.
Right.
So I think that the takeaway that I had was that even though rates are at record high levels over the summer and everybody's talking about how ridiculously high rates are, I kept coming back to, well, but we're only just catching up and rates still aren't where they need to be. And in fact, with Drivan, we're only just back to square one after 3.5 years. So rates need to hold where they are, probably go up some more and run at these levels for another year before you could say that we've recouped all of the losses from the last 3.5 years. Now,
Exactly.
When I say that, I'm excluding all of the massive profits from the pandemic in that debate, right? But if I'm just looking at the big freight recession, April 2023 to now, how do we stand? Well, 32 months was a pretty rough period. And we're just starting to get back to square one.
And the cost of maintenance is really the real humdinger. The cost of maintenance, the cost of parts.
Yeah.
When you really add that all, when calculate that those numbers have skyrocketed over the past over the past 3, 4, 5 years.
See if you can get time in a shop and get out of the shop in a reasonable amount of time too.
Right.
Yeah.
So, and I have the reefer chart up. Reefer was the most stable equipment type this week, declining only 1 cent, showing an average of $2.64 per mile nationally. Truck posts fell by 9.4%, faster than the 6.2 decline in loads. That tightened capacity and raised load to truck ratios from 18.86 last week to 19.51. Very marginal increase, but an increase nonetheless.
Yeah.
Florida and South Georgia averaged only $1.62 per mile for reefer. So you got to be careful if you're down in that part of the southeast.
Those produce seasons have filed their last reports. Yeah. So this is where produce season now starts to move into the northern latitudes, right? You get you get higher above I-40, and you get into the Pacific Northwest where there's some pretty good rates coming out of there right now. California's still very strong. I'll have my produce report out tomorrow to see what rates have done for the week. But we're still seeing a fairly soft produce market. But you've got to see on your chart there, California 261. You got reefer and flatbed there. So I think this is a time for carriers to really take stock of things and just realize that all that sugar rush from before July 4 is really gone, and now's the time to be building really good relationships with your brokers and shippers, because what happens in the next phase of the market when demand finally does return is another surge in spot rates, because the capacity that's leaving is not going to come back quickly, if at all. Because a demand can change in a quarter. A disqualified driver's not coming back.
Right.
A driver that can't get a visa, but they're not coming back. So I think what that means is tighter capacity, higher operating costs, Rico mentioned insurance. That's going to be a big headwind for a lot of new carriers. Diesel's probably not going down anytime soon, so higher costs.
Dean,
And tying everything back
replace
together.
trucks, guys? What about the cost to replace existing equipment because it all wears out?
Yeah.
Have you heard of the pricing for new tractors? It's crazy.
Yeah, expensive. Tim Denoyer at Act Research said at least 10 grand to the cost of a new truck to meet the 2027 EPA regs. So, yeah. And I don't think we've seen the full impact of higher driver wages, because driver wages are going up to try and attract drivers. So the next 6 months is going to see capacity come back into the market to compete with the spot market. So the large truckload carriers are going to actively try and recruit drivers by raising their pay, and that kind of, that's why shippers are trying to reprice a lot of their contracts now and lock in the rates, because I think they're aware that contract rates are repricing up in that 10 to 12% every. They're certainly higher. Their new rates coming into routing guides now are about 15% higher than they were a year ago. So they've repriced aggressively in the first 6 months, all last year's contracts. I think that'll flatten out a bit now that the steam's got out of the market, but then it'll surge again, and that'll, when the contract rates start to take off, when demand takes off, that'll drag the spot market back up also.
But I think you're right about the labor issue. I've noticed listening to the satellite radio. JB Hunt is now competing head to head with Walmart for rates bringing drivers in. And when they do it, then all the other big guys are going to have to do it, and that means the small guys are going to have to do it.
Exactly, it's a good thing. We need more wages.
So, Dean, when it comes to, with everything coming down, we talked about regulatory, but we also still kind of reeling from a little bit of the shockwaves of the Montgomery ruling, with everything coming down with brokers and brokers having to be much more critical when it comes to who they're going to decide, who they're deciding to work with. How much of an impact is this going to be by having keeping your nose clean and keeping a good safety rating? How much value would that be able to provide to the market? I know it's a little bit of speculation, but I'm curious as what your take is on that.
Well, I think it's real. I think compliance just went from being a line item on a P&L to a competitive advantage, right? So that to me is because it's going to be the haves and the have-nots. If you haven't got a good record, I don't know how you're going to get broker rate. Large carriers are going to question adding on owner-operator as a leased owner-operator or an independent to do work for their brokerage firm. I think if you haven't got a good record, that's going to be a real problem for carriers. So if you've got a great record, I think that becomes a competitive advantage, because the pool for the broker market to draw from got very small as a result of Montgomery. So for carriers like you, that's your advantage now, and I think that's something you can sell from.
Right. So you're going to have to. I'm thinking that keeping your nose clean is going to be invaluable, of course, and trying to maintain that if it's spotless or if it's maybe doesn't have. Because I tell you, I get a lot of, when I've been negotiating lows, I've been getting a lot of brokers when they pull my MC number, they say, "Man, okay, yeah, everything looks good here."
Exactly.
Not to necessarily brag, but but that's something that I've kind of always prided myself on. I try my best to not run afoul, and give and necessarily give DOT or the FMCSA a stick to beat you with. They're going to beat you. They're going to beat you regardless. But I'm not going to give them a stick to do it.
So I think this is your competitive advantage, Rico. I think that's where the differentiation. Now, Montgomery really focused on the broker side of it, but you want to bet the first court case is going to go straight to the shipper too. They're going to ask questions of the shipper, and I think that's where, if you're a contract carrier like you are with your shippers, they're going to have to do their due diligence just as much as a broker will. Even though Montgomery didn't include, I did know that a plaintiff attorney is going to ask the question all the way along the supply chain in the event that there's an accident. And unfortunately, it's going to require an accident or court for to test out all of this. That's sad part.
Oh, and there's lots of them coming down the pike. And mark my words, there will be one of these cases where it'll be a small broker and he's not going to be able to afford the legal fees. He'll close up and they will go right after the shipper.
Yeah. Yeah. This is this is the great recredentialing era. 2026 will go down as the great recredentialing of brokers, training schools, carriers, FMC entry requirements. Everybody's going through a recredentialing, and that's why Rico's point about keeping your nose clean, that becomes your competitive advantage in the marketplace, where you can command not just higher rates, but actually get loaded. Like get loaded when you need to instead of sitting.
And they just kicked off a couple of more ELD providers. Is that correct, Dean? This week?
Yeah. So they've done, I looked at the numbers. There's something like 1,200 have come in since 2018. They've kicked off 157, revoked them. But Rico, 51 of the 157 are this year alone. So,
Wow.
157 revoked since 2018, 51, I think it's about 40% this year alone. So they are really going after, which is, they should have been from day one. We should never been self-certifying. Like the Canadian model was always the model we advocated for, which is an independent. That's why I think Canada's only got like, is it 42 ELD providers, Chuck? Something like that.
Yeah. A few dozen. That's it. Where you guys had hundreds of them.
We're up to, where was 1,200 when I last looked? Yeah.
Every computer program that walked the floor at Matt's decided he's going to start writing programs for ELD. This is real easy. Make a lot of money. And some of them really did.
Yeah.
So, I think that's something that's going to have to get, they're going to have to close that back door on a lot of these ELDs, because you still have people out here you still have a bunch of ELD fraud that is taking place in the marketplace, and you still got people that are running up and down the road, putting families and themselves in jeopardy by running as illegal as they are running. I mean, it's some of the stuff. I believe I shared some of that stuff with you before that I seen on Instagram. Some of the stuff is just absolutely egregious that some of these people are out here doing. And I'm not to begrudge anybody from trying to provide and put food on the table for their families, but some of the stuff that I've seen and come across is absolutely ridiculous.
Serious jail time if you get caught.
I don't think the juice is worth the squeeze by putting yourself in that position of doing that. And the crazy thing is that you're sitting here bragging about it on social media. I mean,
I can't figure that one out. If you're really doing it, that's like going on social media saying, "I robbed 20 banks today."
Convict yourself. They don't need you do the prosecutor's job for them. But okay, Dean. So we kind of getting a little bit into we're getting to the part of the show. I guess we're going to get ready to wrap this thing up and put a bow on and let you get back on the road there. But are there anything that you want to leave us with? Any kind of closing remarks or anything that we need to be aware of for the upcoming week?
No, I think it's a week to take stock. I think it's, first of all, come to grips with the fact that the steam's got out of the market and rates are falling and demand is softening, right? So shouldn't be any surprise to anybody, because that's the dog days of summer. And when people go on vacation, they spend more on services, airlines, hotels, theme parks, and less on physical goods like furniture. So that's sort of, just remember, this is the time of the year where rates fall. Now's the time to be, watching your speed, getting your MPG right, like keeping your nose clean, but really build that relationship with whoever it is provides you freight. Because the people that are providing you with loads on the shipper side, they don't fully appreciate how tight capacity is going to be when the market turns. So that I was just with a bunch of shippers last week, and they're not fully across how tight capacity is, because they're still reeling from high rates, thinking it's a cycle. And I said, no, the structural removal is permanent of this capacity. These drivers aren't coming back. So, and the door that drivers come through just very narrow. Become high pay, higher costs. I think what we're seeing now is a step change in the cost of a vehicle, Rico. Tariffs on steel and aluminum, driver wages, so we're higher operating cost. Now, I'd be going very deep with all of my partners to make sure that I'm in good shape for when the market does really take off and demand starts to really drive more freight volume, which will come when we get into that holiday season this year.
Well, it does every
Yeah.
year, a holiday season, but that's what. Dean, what do you think that we are going to go back? Years and years and years ago, in North America, anyways, truck drivers were paid by the mile or by the hour.
By the hour.
Do you think we're going back to that?
I think smart companies will, where they can get them the miles. I think that's where the smart money would be. I think, the challenge I see is, I don't think it matters how much you pay me. If I can't get the miles, it's immaterial. And I think that's where a lot of fleets have problems. If you're only going to give me 2,300 miles a week and that's the best your dispatch can do, man, I probably need $1 a mile. I don't know. I'm just sort of spitballing here, but I think companies that can price the contract correctly and pay drivers hourly, I think that would be a winning move, as have some of the Canadian carriers already found that that's a good way to build your business, where they have, 95, 97% contract work that's paying well and less on the spot. So, yeah, I think that's Chuck, but I think they're going to try and go with the driver pay increase now to attract drivers with big sign-on bonuses, high mileage rates. I think they'll still have the retention problem because I don't see the efficiency to get them the miles to hold them.
Right.
When that driver's sitting at a loading dock for 7 hours, waiting to get unloaded, his day is shot. How are you making up to it? You're going to give the guy $100. Like, come on, he's got bills to pay.
Yeah.
Yep, and I think that's going to be for owner operators. I think that's going to be a critical component in your pricing. You got to make sure that you are pricing in your spot market contracts. Detention, you got to make sure that you put in some type of on the rate confirmation. Make sure that you get your detention spelled out specifically, and if the detention that the broker is saying that they pay is not sufficient, then you got to be creative enough on your all-in price to make up for that. So make sure that you're always keeping those things in mind and in line. All right, Dean. Well, we appreciate you for taking the time out, driving and managing and the technical difficulties and all coming on and kind of helping us out there, kind of break down on some of these numbers and give us a little bit more insight into your work. We definitely appreciate it. For people that want more information or want to be able to find you, how can they get in contact with you, Dean?
LinkedIn's the best. Dean Croak at LinkedIn. You can watch my IQ show Mondays 11 a.m. You can send me your email address on LinkedIn, direct message me, and I'll add you to it. LinkedIn's best, Rico.
Okay, and for anybody else that's on social media, he goes by the Grumpy Pete out there on Instagram. Pretty cool Instagram. Dean has a nice pretty show truck that he very proud of, and it's I tell you, it's something to behold.
Heading to Canada tomorrow.
He don't just talk. He don't just talk freight. He actually got a little diesel running through his veins.
A lot of diesel running through his veins.
Thanks for having me, guys.
All right, Chuck. Well, how do folks, if they got questions or anything, they want to get a hold of you, how do they get a hold of you, Chuck?
Just send me an email, chucksnow280@outlook.com. And best way to get me, I don't do LinkedIn right now because too many people are offering me jobs and I don't want to go back to work. Sorry, guys.
Well, man, I'll tell you, it's nice. It's nice to have that. That's a good problem to have.
Yeah,
that's a really
absolutely.
Good problem. But for ladies and gentlemen, we want to thank you guys. You guys are the most important portion of the show. You could have been anywhere else in the world, but you took some time to hang out with us. We're always grateful for you doing so. If you would do us a huge favor, make sure that you like, share, and subscribe. It doesn't cost you a dime, but it helps us out tremendously, puts us into a bigger algorithm for the YouTube folks and for the Instagram folks and all that good stuff. So we need all the help we can get with that. And with that being said, we want you guys and girls out there to continue to stay safe, stay healthy, keep it in between the mustard and the mayonnaise, and we'll talk at your same time, same place next week. God bless you and good night.
Good night.
Catch you on the flip flop. God bless.
Drive safe out there,
I will.
Dean.
See you
Be
guys.
safe. God bless.